What if I told you that most people pursuing early retirement through dividend ETFs are underestimating the required capital by millions of dollars? Because the internet sells a fantasy. Buy a few high-yield ETFs, collect passive income, retire at 40. But the real math behind financial independence is brutal. At today's yields, generating $100,000 per year in sustainable dividend income may require a portfolio approaching $3 million. And that's before inflation, recessions, taxes, and market crashes. So why do sophisticated investors still obsess over dividend growth investing? Because the real power of dividend ETFs is not yield, it's compounding. In this video, we are going to examine whether dividend ETFs can realistically fund early retirement in America today. We will analyze 4 major income-focused ETFs, compare yield versus dividend growth, model long-term compounding scenarios, and expose the hidden dangers that can permanently damage a passive income strategy. By the end, you will understand whether dividend investing is truly a retirement machine or simply a comforting illusion. The appeal of dividend ETFs is easy to understand. Unlike growth investing, where investors rely primarily on selling shares for liquidity, dividend investing creates recurring cash flow directly from portfolio ownership. That psychological difference is enormous. A retiree receiving monthly or quarterly distributions may feel less dependent on market timing and less vulnerable to volatility during bear markets. But not all dividend strategies are equal. The highest yielding ETF is rarely the safest ETF. Professional dividend investors focus on 3 critical metrics: dividend yield, dividend growth rate, and payout ratio sustainability. A healthy passive income stream depends on businesses generating durable free cash flow through multiple economic cycles. This is precisely why Dividend Aristocrats and Dividend Kings matter so much. These are companies that survived inflation shocks, recessions, rate cycles, and financial crises while continuing to raise distributions year after year. The ETF structure simply packages these businesses into scalable, diversified exposure. But diversification alone does not guarantee retirement success. The real question is whether dividend growth can outpace inflation while simultaneously funding living expenses. And that depends heavily on ETF selection. The first ETF in this analysis is the Schwab US Dividend Equity ETF. SCHD has become one of the most respected dividend ETFs in the United States for a simple reason: balance. The fund combines moderate yield, strong dividend growth, and quality screening focused on profitability and free cash flow generation. Current metrics remain compelling. Ticker SCHD. Dividend yield approximately 3.5%. 5-year dividend CAGR near 11%. Expense ratio extremely low. That final metric matters more than many investors realize. A low expense ratio allows compounding to remain efficient over multi-decade holding periods. SCHD also avoids one of the classic traps in income investing: yield chasing. Instead of concentrating heavily in distressed, ultra-high-yield companies, the ETF emphasizes financial quality and sustainable distributions. That distinction becomes critical during recessions. A 10% yield means very little if the underlying dividend collapses by 40%. Over long periods, SCHD historically benefited from dividend growth acceleration rather than excessive starting yield. And that is the hidden engine behind sustainable passive income. Compounding dividend increases over 20 years can radically transform yield on cost. The next 2 ETFs prioritize a different philosophy. Not maximum income today, but rising income tomorrow. The Vanguard Dividend Appreciation ETF focuses on companies with long histories of dividend increases. Meanwhile, the iShares Core Dividend Growth ETF emphasizes sustainable dividend growth supported by earnings expansion and payout discipline. Their metrics tell an important story. VIG, yield around 1.9%. 5-year dividend CAGR near 8%. DGRO, yield around 2.4%. 5-year dividend CAGR near 10%. At first glance, many retail investors dismiss these ETFs because the current yield appears lower than high-income alternatives. That is a mistake. Early retirement is not merely about generating income today. It is about preserving purchasing power for potentially 40 years. Inflation silently destroys fixed income streams. Dividend growth is the mechanism designed to fight that erosion. A portfolio growing distributions by 8% annually can potentially double income approximately every 9 years. The goal is not simply high yield. The goal is rising cash flow backed by expanding corporate earnings and durable economic moats. Now we arrive at one of the most controversial ETFs in modern income investing, the JP Morgan Equity Premium Income ETF. JEPI became extremely popular because of one number: yield. In certain market environments, the ETF distributed yields exceeding 7%. For retirees seeking immediate passive income, that sounds extraordinarily attractive. But investors must understand where that yield originates. JEPI partially generates income through covered call strategies. That creates higher distributions, but also limits upside participation during powerful bull markets. This introduces a trade-off many investors underestimate. Higher current income may come at the cost of lower long-term compounding. And over 20 years, compounding is often the dominant variable in retirement sustainability. This does not make JEPI a bad ETF. In fact, for certain retirees prioritizing present cash flow stability, it may serve a valuable role. But relying exclusively on high-yield products can create structural portfolio weakness, especially when inflation rises faster than distribution growth. Income investing without growth eventually becomes fragile, and fragile portfolios rarely survive multi-decade retirements intact. The script analyzes the JP Morgan Equity Premium Income ETF, highlighting its appeal for high yield and its mechanism through covered calls. It discusses the trade-off between immediate income and long-term compounding, cautioning against over-reliance on such products for retirement sustainability, especially considering inflation and potential portfolio fragility. So, can dividend ETFs truly fund early retirement? Mathematically, yes, but the capital requirements surprise most investors. Consider a hypothetical portfolio generating a blended 3.5% dividend yield. To produce $100,000 annually before taxes, an investor would require approximately $2.8 million invested. 100,000 divided by a 3.5% yield equals approximately $2.85 million. That number sounds intimidating, but this is where dividend growth changes the equation. If the portfolio grows distributions at 8% annually, while the investor continues reinvesting during accumulation years, yield on cost can rise dramatically over decades. A portfolio initially yielding 3% may eventually generate double-digit cash flow relative to original capital invested. That is the real power of dividend growth investing. Not immediate wealth, but accelerated compounding combined with rising passive income streams. The investors most likely to succeed are typically those with long-time horizons, consistent capital contributions, low expense ratios, and disciplined reinvestment strategies. Dividend investing rewards patience far more than prediction. Now, for the part most YouTube channels avoid entirely, the risks. Dividend ETFs are not immune to valuation bubbles, sector concentration, or economic disruption. Many high-yield portfolios become dangerously overweight in utilities, REITs, telecoms, or financials. When interest rates rise aggressively, these sectors can underperform for extended periods. There is also the danger of dividend traps. A collapsing stock price can artificially inflate yield percentages, creating the illusion of opportunity while underlying fundamentals deteriorate. Professional investors monitor free cash flow trends relentlessly for this reason. Dividends unsupported by earnings quality eventually fail. Another major threat is sequence of return risk. An investor retiring immediately before a prolonged bear market may face severe psychological stress even if dividend income remains relatively stable. This is why intelligent retirement planning extends beyond yield alone. Liquidity reserves matter. Diversification matters. Valuation discipline matters. The objective is not maximizing yield. The objective is creating resilient cash flow systems capable of surviving decades. Dividend ETFs can absolutely contribute to early retirement, but the investors who succeed rarely treat dividend investing as a shortcut. They treat it as a system, a long-term framework built around compounding, disciplined reinvestment, free cash flow quality, and rational expectations. The real question is not whether dividend ETFs work. The real question is whether investors possess the patience required to allow compounding to operate over decades. So here's the question for you. Would you rather pursue maximum yield today or lower yield with stronger dividend growth over the next 20 years? Leave your perspective in the comments. And if you value institutional quality analysis on Dividend Aristocrats, Dividend Kings, and long-term passive income strategies, subscribe to our channel. This video is for informational and educational purposes only and should not be considered financial advice. Investing involves risk, including possible loss of principal. Always conduct your own due diligence before making investment decisions.